Welcome, everybody, to Tokens of Wisdom. I'm your host, Dave Rothschild, but y'all know me pretty well already, so I am delighted to have on the show today Colleen Fay. Colleen is a tax partner and financial services practice leader at Withum, and she's the host of what many are calling the second best alternative investments-focused podcast, The Alternative Route. Now, before we dive into the episode, please listen to the disclaimer at the end of the show. Nothing said here by myself or by Colleen is legal, investment, or tax advice. Colleen is doing me a solid and joining the show to share her considerable fund-related wisdom, but everything she shares here is her own personal opinion for educational purposes only. She's speaking for herself, not for her employer or any other affiliated entity. Okay, boring stuff out of the way. Colleen, welcome to the show.
Dave, thank you so much for having me. I'm very excited to be here.
I am so excited to have you. It's been a long time coming.
Yes.
So I wanted to have you on today to talk very high level about tax things that impact funds and fund managers. And I thought you would be a great person to describe sort of how taxation at a fund, how fund taxation works and what aspiring managers should know before they dive in and decide they're going to do this. So, to start with, I figured we talk about the fund, and most U.S. domestic funds are structured either as limited partnerships or as LLCs. And in either case, the income passes through the entity and goes to the underlying owners. Can you tell me what that actually means in English?
Sure. So because funds generate investment type income like your interest, dividends, capital gains, that flow through structure, whether it's an LLC or an LP, it allows the investor really to avoid double tax on any distributions out of the fund. And there's less issues with investment type income for your tax exempt and foreign partners. So something like a tech company in comparison, they may generate ordinary type or operating income, and that has different tax implications for those foreign and tax exempt investors based in the US.
Got it. So when you say double taxation, why would it otherwise be taxed doubly?
So if you had a corporate entity instead, the corporate entity pays tax at its level. And then when they distribute income out to the shareholders, they then have to pick up that income potentially as dividends or capital gain. So there's tax at two levels. Whereas this flow through structure, you aren't paying anything at that partnership level. It's all coming through to the ultimate investor, and they, aggregate it with their other sources of income on their own tax return.
Got it. Okay. So the fund itself isn't actually paying any taxes. Instead, they are reporting the income that they generate to their limited partners or members if it's an LLC, but we'll just use limited partners for now. They're reporting that income to their limited partners, and the limited partners report that income on their tax return and pay taxes on that income the way they would on any other income they're making.
Exactly. So it flows through one entity and just lands on the ultimate investor level.
Got it. Very interesting. Now I understand pass-through taxation.
Who knew it would be so exciting?
Are there categories of investors for whom this can cause issues?
Yeah. So I mentioned who the pass-through structure can cause potential issues for would be your tax exempt, like your IRAs or foundations, and any foreign partners. There are certain types of income they may want to avoid. So, like your funds that use leverage or debt financing to make their investments, that may be an issue for your tax exempt investors. And then any income that's operating income, if you have, say, like a private equity fund and they're investing in a portfolio company that's also a pass-through itself, it is going to send down that operating type income, which eventually will go down to your, say, foreign investors. And if it's U.S. sourced, there may be implications for your foreign investors. Got
it. Okay. This is something that has tripped me up considerably over the years. Like, let's say I'm just a hedge fund and I'm investing in public stocks. I'm a limited partnership, so pass-through taxation. I have a Delaware limited partnership. And now all of a sudden I'm getting a bunch of interest from non-U.S. persons. They might be from anywhere, but they're not U.S. taxpayers. Is does pass-through taxation cause an issue for them? And if so, what issue does it actually cause? What is the problem for them?
So in that example, if you have interest or dividends, that is, you're earning at your partnership fund level and you have foreign partners in your fund, it's not necessarily an issue for them with that type of income. There may be some additional withholding requirements if you have U.S. sourced dividends or interest. But it is another reporting requirement and potential withholding for those foreign investors.
So they might have to report something to the IRS as a consequence of being a limited partner in a Delaware limited partnership.
Exactly.
And sorry, go ahead.
I was going to say the bigger issue would be if it's not interest or dividends, but let's say you invest in a private equity type structure. If you invest in a portfolio company like a widgets factory, right, and that's flowing through operating type income to you, including your foreign investors, that income is U.S. sourced. That may cause a different filing requirement for your foreign investors and some other withholding implications.
Got it. And so if I'm just a foreign person with no other U.S. presence, no tax filing obligations, nothing to do with the IRS, and then I buy an interest in a Delaware limited partnership, at the very least, it sounds like I might have some IRS reporting obligations in respect of the income generated there, and I might have, depending on the character of that income and what the underlying income is, I might have more onerous reporting or withholding requirements.
Correct.
And so what do managers do to solve for that? Because obviously I have a lot of clients who are raising capital from non-U.S. or tax-exempt U.S. persons and trying to figure out how to make the investment as palatable as possible is what the new manager wants to do. If you're pitching a fund to potential investors, you want to remove the barriers to entry and give them as an easy a path as is possible. So what are some solutions you see to this?
Sure. So depending on how sensitive the investor may be, because some are okay with that type of income flowing through to them. They may already have investments and they're handling that. And there's some that are, absolutely want to avoid it. So one way to avoid it, or at least some of those implications of reporting and withholding for them, is to set up a blocker entity. So that's an entity they can invest in. It's essentially a corporate entity. So it's opaque. It's not that flow through type where they have to handle things at their own investor level. And that blocks anything it can help for your tax exempt investors as well as your foreign investors.
Okay, so I would set up a blocker entity that's taxed as a corporation. But then I guess the problem will be the double taxation that you talked about earlier, in the sense that if let's say I set up a Delaware Corp, that Delaware Corp is going to be paying corporate level taxation on the income. And then once it flows up to me as a shareholder in that corporation, there might be another layer of tax. So is this why people set up blocker corps offshore?
Exactly. Right. So if you use, say, like a Cayman blocker, an LTD, and the income is that investment type income, it doesn't have as much implications for a double tax because you're only concerned about U.S. source, dividends or interest.
Got it. And so, that in the Cayman Islands, for example, they don't have an income tax. And so that Cayman Corp is not actually paying any tax on the income that it generates, as the Cayman Corp itself is a limited partner in your fund. The income generated flows through to that Cayman Corp. There's not income tax in the Cayman Islands. And so the corporation itself doesn't pay tax on that income. And then your non-U.S. or tax-exempt U.S. investors can be shareholders of that Cayman corporation and then eventually get a distribution from there. Is that the idea?
Exactly.
And I've had some clients over the years ask me, well, is this just a way to totally avoid taxation altogether? Like, do non-U.S. and tax-exempt investors never have to pay tax on income that they generate through a structure like we just discussed?
No, I think it is interesting with the UBTI conversation for tax exempt investors. The corporate entity acts as a blocker, but they are, there's pros and cons of it as well, right? So in that structure, all of the U.S. dividends earned by the offshore blocker are going to be subject to the U.S. withholding on dividends. if they were invested directly, some of that may be exempt. Like for a tax-exempt investor, they wouldn't have to pay that withholding tax, but they're getting the benefit of having UBTI blocked in a year where there may be more leverage one year versus another.
Okay.
So there's trade-offs.
And then I'm assuming that if I'm a non-U.S. person, I mean, obviously you're a U.S. tax specialist, but if I'm a French taxpayer or a German taxpayer or whatever, I'm probably paying some tax in my home country based on this income. It's not like a get out of tax free card to structure your fund in this way where you've got the offshore corp that feeds into a Delaware fund.
Exactly. A lot that capital gain type income they're likely paying at their own, home country.
Yeah. Okay. So I guess from the U.S. perspective, what you're gaining in, having this offshore corp in the structure is you are saving your non-U.S. investors or your tax-exempt U.S. investors from an IRS filing obligation that they would otherwise potentially have. Is that right?
Exactly. It takes them having to do their own filing requirement and it aggregates it at one level and allows the fund manager really to be responsible for making sure that that's all done.
And then is that Cayman Corp in the example we're talking about now? Does that Cayman Corp file something with the IRS?
Yes.
Yeah. Okay. So the IRS is still getting all the information they want. You're taking the burden off of the investor and putting it onto the fund itself or the fund manager.
Right. So it happens at the blocker level rather than putting it on each of the individual investors.
And do you find for most of your clients that have significant non-U.S. or tax-exempt U.S. investors that they have a structure like this to solve for this issue? Is this something that an aspiring manager should have on the forefront of their mind as they're thinking about setting up their fund if they expect significant interest from those classes of investor?
I think there's a cost-benefit analysis that a new manager would have to go through, right? They'd need to have, like you said, significant foreign investor interest, but also have an idea of what type of income they're going to be generating. Because it may make sense for some and not others. And then there's always the cost to administer these entities.
Yeah. The offshore funds do add meaningfully to the setup costs and organizational expenses of a fund launch.
Right. And then the recurring expense, right, of like if you need an audit on that entity, that's an extra cost. There's an additional tax return and compliance things there. So there has to be a certain amount of interest and a certain type of income that is going to make it worthwhile for you to set this up.
Got it. So it's not just a one-size-fits-all answer.
Exactly.
Always nuance.
There's
always nuance. The taxes and the lawyers, you never get a straight answer. You did mention an acronym in your answer to the last question, UBTI, and that's one of two scary sounding acronyms that I hear frequently when I'm talking to potential fund managers about tax issues they might encounter. So can you explain what UBTI is?
It is a 4-letter word, but it stands for unrelated business taxable income. So tax-exempt investors are concerned with, some are sensitive to it and some want to avoid it completely. And that income really arises from funds that may use leveraged or debt financing to make their investments, as well as in that example of a fund that invests in other portfolio companies also structured as a pass-through. Any type of operating income would be considered unrelated to their tax-exempt status. So it qualifies for that treatment as well.
Interesting. And so why is it a 4-letter word? What problem does it generate for those kinds of investors?
So typically a tax-exempt investor, right, is exempt from paying income tax. But there are certain types, if it's unrelated to your tax-exempt status, if you go over a certain threshold, that tax-exempt investor has to file and potentially pay some income tax.
Got it. So tax-exempt only applies up to a certain level or only with respect to certain income.
Yes, exactly.
And so if I'm talking to a tax-exempt investor trying to convince them to come into my fund, they might have issues if they think the fund is going to generate UBTI.
Right. So they're often asked, like, do you plan to use leverage or any type of debt financing in your investment strategy? And if so, then they may request to be in a blocker like we just talked about. And if you can confirm, I will never have a leverage strategy, then they may stay in the flow through entity.
And will the blocker that we just talked about solve this problem for tax exempts?
Yes, but so the pros and cons of it solves for the UBTI portion of it. It blocks that completely for them, but they are a U.S. investor at a tax exempt. If there's any U.S. dividend income that is allocated to that blocker on behalf of the tax exempt investor, there would be withholding if it's a foreign blocker. So there is some loss on the return on their investment in order to protect from the UBTI. So there's a little bit of give and take there.
Interesting. And so I guess this is why I will often have tax exempt investors requesting either in the partnership agreements or side letters that you're going to either not generate UBTI or you're going to make sure that you only generate a little bit of UBTI.
Right. And we always look at that, I think, ahead of fund formation, just to make sure you're not agreeing to anything that may be difficult to kind of put into practice, like notification 60 days before you plan to use leverage, right? Like, is that realistic that you're going to have a reminder somewhere that tells you I have to tell someone before I go make this investment?
Right. And this is why I always tell my clients to talk to their tax folks about provisions like that.
Yes, exactly.
So that you can flag those issues. And so UBTI, this is only an issue for tax exempt. It's not an issue for non-U.S. investors specifically?
Correct.
Okay. I did not know that. Anything else you think we should talk about related to UBTI?
No, where you just said, is it matter for foreign investors? For foreign investors, it's not a four-letter word, but it's ECI, effectively connected income. And there's a lot of similarities between what qualifies as ECI and UBTI. So that may be where you've seen them commingled in the past.
Understood. Okay. So what is ECI?
So ECI is effectively connected income, which means it's related to a trade or business within the United States. So if you have like a widgets manufacturer, any kind of operating business in the United States that's structured like a flow through, that would qualify as ECI.
Okay. And what happens if the fund generates ECI? This is a problem for foreign investors, or is this also a problem for tax exempts?
It's a problem for foreign investors. It's just that operating type income, it's unrelated to tax exempt, so it's the same type of income, and it's also effectively connected to the U.S., so it's an issue for foreign investors.
Okay, got it. Is all UBTI ECI and vice versa, or is there in the Venn diagram of UBTI and ECI is it a perfect overlap, or is there a?
It's not a perfect overlap. The thing about UBTI that is not ECI is where you're using leverage or debt financing to make your investments, right? That's still investment type income for your foreign investors, but it is potentially UBTI for your tax exempts.
Got it. Okay. And then the same blocker structure, is the same blocker structure going to solve the ECI problem for foreign investors like it does for the UBTI for tax exempts?
Right. If you have the blocker structure in place and there's ECI, the tax is all paid at the blocker level. So it removes that filing requirement for your individual foreign investors.
Okay, great. So it sounds like our offshore fund blocker structure solves a lot of problems for all kinds of different investors.
Yes, exactly.
That's great. Is there anything else at a very high level that you think aspiring managers should be thinking about from a tax perspective when they're thinking about fund structure?
I guess one of the areas we talk about a lot is the setup of the management company and the general partner entity. It's not the fund specifically, but having those two. Obviously, there's different streams of income that they're receiving. Mm-hmm. So I think it's become more of an industry standard for years to have the two separated. I think initially it had a lot to do with New York and the UBT tax, right. Different three letters, and trying to make sure that, the carry type income wasn't commingled with the management fee income and pulling that in to be subject to that tax. But I think as that's evolved and there's fund managers in every state, it's less about obviously that piece of it and more about flexibility if you want to grant some of your employees or your investment team different share of the carry, having that GP entity separate from the management company, it's easier to, you have more flexibility on what you can grant them without having them become a partner within the management company.
Got it. Yeah, this is something I talk to clients about all the time, and I think there are also some legal reasons to, I call it bifurcate the management company from the general partner. Getting into legal liability reasons that we don't have to talk about on this episode, but I've probably talked about on this show before. But I am curious about, I have long heard about the New York specific reason for bifurcating, and you just touched on it. There's some New York specific tax. By bifurcating, is it that you remove the incentive allocation or carried interest piece from the purview of that tax, or is it the management fee income you're taking out of that?
You're removing the carry piece from that purview.
Okay. And so that's New York City specific. And then if I'm somewhere else, let's say California, am I necessarily generating any sort of tax savings by bifurcating my management companies like that?
No, not a tax-related savings.
Okay. So the reasons to do it would be, legal liability, or like you mentioned before, ease of granting pieces of carry to employees, things like that, and then just kind of common industry practice.
Right.
One thing I like to tell clients when we're talking about this specific topic is that it is very common to bifurcate your management companies, and in certain circumstances, there are tax savings you can generate by doing so. Specifically in New York, it's always done. But, everything has a cost, right? And so if I have two entities instead of one, can you talk me through a little bit, from a tax perspective, what are the additional costs I'm going to incur? I assume, each of these entities is going to have to, prepare K-1s and maybe has to make a tax filing. And there's some cost associated with doing all of that twice instead of once, I would assume.
Right. So exactly that. I think on an annual basis, you have two tax returns instead of one. But on the flip side, sort of tax related, if you have owners of the management company, so, typically you're two fund managers, and you have employees that you're paying wages, they're getting a W-2, right? They're not partners of the management company. But
Right.
if you want to grant them some share of the carry, they may be able to be at least a tax related partner, if not, an economic interest in the general partner. If those entities are commingled, you could grant your employee carry, and they would receive a K-1, but then they can't also be an employee of that same entity. So there is some planning around that if you do want to offer that benefit to your team.
Interesting. Why can't someone be an employee and also a K-1 recipient? I'm not sure what the right word there is. Partner, I guess.
Yeah, so I guess either you're an owner and a partner, or you're an employee of the entity. So if you have the management company and GP commingled, you can't be one of each.
I got it. Interesting. Very interesting. So do you, for most of your fund manager clients, you see them, obviously you're based on the East Coast. I assume you have a lot of New York manager clients, but let's talk ex-New York, non-New York clients. Are most of them still bifurcating these management companies?
I'd say, yeah, the vast majority of our clients are bifurcating them. And one thing, not to muddy the waters of pass-through and entity level taxes, but for state purposes, there is a concept of pass-through entity tax. And we had a lot of management companies that would qualify to make that election. Whereas your general partner entity, you may not want to do it in, or it may not make sense. So that at least up until this point has been part of the reason for state purposes to separate the two in states beyond just New York. And I caveat that with some of the recent proposals that are coming through may change how that's done. But as of right now, the pass-through entity tax in a lot of states that funds are operating in may find it beneficial to elect into that. In which case it may be, maybe part of the reason you keep your management company separate from your GP.
Yeah. I've definitely had a lot of conversations over the last handful of weeks about uncertainty about what's to come tax-wise with new legislation coming through and things like that. So it's fun times for all of us.
Keeps it interesting.
It definitely keeps it interesting. One quick question on this topic is, For a while, I had some clients who were structuring, they were actually having three management companies, one and making their GP they have and their management company is separate, but they were structuring their management company as a limited partnership. And then, for legal liability reasons, if you have a limited partnership, you need an LLC on top. So it wound up being three management entities. And I'm seeing that less common these days, maybe a little bit. Can you talk briefly on why people did that and
Sure.
why they might not be anymore?
Yeah, so there's still potentially some benefits to structuring an investment manager as an LP, but that's if the management company projects it's going to be profitable. And I think, as emerging managers are getting set up, oftentimes they maybe break even the first few years or even operating at a loss. So that LP structure doesn't really give you as much benefit. That LP structure has more to do with a portion of your income not being subject to self-employment tax. That was kind of the reason people were structuring that way. That's definitely being scrutinized, and there's been two tax court cases. They have not actually gone back and changed the regulations as of yet to clear up the definition of limited partner. So that's why still you may see some management companies setting up in an LP form. But that's something that I think we're kind of constantly watching because it may eventually change and close that option that people have used in the past.
Yeah, so my understanding of that, and please correct me when I butcher this, is so you set up your management company as a limited partnership. And then, if I'm the principal, I am a limited partner of that management company, and I take the bulk of my management fee economics in that capacity. So I am a limited partner of the management company. I own 99% of the economics. The LLC, that's the general partner, owns 1%. If there is management fee income, to your point earlier, there very well may not be. It's getting distributed up to me as a limited partner. And, I guess some people were taking the position that distribution to the limited partner is not subject to self-employment tax. And then there were some tax court cases that basically said, yeah, technically you're a limited partner of this limited partnership, but, you're actually running the partnership. So you're not really acting as a limited partner. You're not a passive investor in this entity. You're just calling yourself a limited partner for, state partnership law purposes. But in reality, you're in charge of this entity. So you're not actually a limited partner as the tax code defines it. Is that kind of how it went?
That's essentially it. The only, I think, misconception in that whole scenario is that the management fee income that we're saying would flow up to you, not subject to self-employment tax. There has to be an amount that you're receiving as a reasonable compensation for the services you're providing, right, to the fund and the management company. So it's not like 100% of the income flows through to you, not subject to self-employment tax. There's an amount that has to be subject. It's, as part of the guaranteed payment to you for the services you provide.
I see. So then it almost sounds like I would need to be making even more management fee income in order to get this tax benefit.
Exactly. So it's not as wide of an amount of people that were benefiting from it. And it's not like 100% of the income was escaping self-employment tax.
Understood. And yeah, going back to one of the things you said earlier that I like to say to clients, there's always a cost benefit analysis. If you're not generating that management fee income, why have three entities when you could accomplish the same goal with two?
Exactly. And I think when you have that conversation and then realizing they need to pay themselves essentially a guaranteed payment or salary, and they budget out the first few years and they're not going to be, they're going to be closer to break even than anything, it may not make sense to have all of those entities.
Perfect. Makes total sense. Okay. Well, great. So we've talked fund tax, we've talked management company tax. I feel like I'm a tax expert now, so thank you for that. Let's talk sort of about your business and your clients. Do you work with all kinds of fund managers? Do you have a specific focus?
Yes, we work across the spectrum of venture capital, private equity, hedge funds, digital asset funds, within private equity, private credit. So yeah, it kind of spans the whole spectrum of funds.
Great. And are your clients, I know Withum does audits and you provide tax services. Is that like a package deal? Do you do one or the other? Do most clients hire you for both?
I'd say a large majority of our clients will use this for both audit and tax on the funds. But we do have some fund clients that are tax only because maybe they don't require an audit. Or on the flip side, they are large and have institutional investors that may mandate the use of a different audit firm, but they can use us for tax compliance and consulting.
That makes sense. And then, I mean, this is probably a very broad question, but feel free to answer it however makes sense. How do you charge for your services? If I wanted to hire Withum to let's say, do tax services for my fund, should I think about pricing?
Sure. So, I mean, typically when we're talking to, an emerging manager, we're going over what they expect to include in their fund, right? Like, what are they investing in? How many investors do they have? Where are they located? What type of investments are they? From a tax perspective, do they require additional analysis or not? Packaging all those things together, we come up with what we try to have be a fixed fee. Because really what we're trying to do is make sure that we create an environment where you're calling us proactively. Because I think, as we both know, it's easier to talk about things to consider before they're done than it is to unwind something that maybe was done unintentionally or had consequences that maybe they didn't realize were part of that structure.
Absolutely. So mostly fixed fee.
Fixed fee, right. And then if there's something that comes up outside the scope of what we thought was going to be included, we try to have a conversation ahead of time, right? So that everybody's kind of on the same page. Because especially with emerging managers, they're getting up and running. Unexpected bills is sometimes difficult to plan for. And may have some unintended consequences. So trying to be ahead of that, we try to package it as a fixed fee, knowing as much as we can going into it.
That makes sense. You've kind of answered this already, but is there any information we haven't talked about that if I'm getting ready for my intro call with you as a new manager, is there any other information that you would need from me to scope out the services and the fees that you would charge, or have we talked about most of the info you need?
Yeah, I mean, it covered a lot of what we need. I think some of the areas like, intended targeted capital or commitment amount that you think you may have. No one has a crystal ball, but at least a ballpark. Number of investments and investors, even size of investment. I think, I'm a tax person by background, but with audit, obviously valuation is an issue. So making sure you have an idea of how that's going to work, operationally for you and your fund.
And then how should I think about, there are all kinds of providers out there that could provide tax services to me as a new manager. What should I think about? How should I think about evaluating different providers? What's important when I'm making this decision?
I mean, I think it's important to consider a firm that's the right size for you when you're starting out, but also one that can grow with you long term. I think having people that you like to work with is also important. So I think that's something that people should consider, right? Because you're going to be working with these people, not necessarily day in and day out, but you have to have a relationship, somebody that you want to reach out to as a trusted advisor. So I think that's important to consider when you're choosing any of your service providers as a new fund manager.
Yeah, especially going back to the point you made earlier of, wanting to encourage people to pick up the phone and proactively call rather than, make a mistake and then come to you afterwards to fix it.
Yeah. And we did talk a little bit about the management company, but like for a new fund manager, like this may be the first time that they're receiving K-1s, right? And don't just have a W-2. So there's a lot of different things to consider being now in this seat or wearing these hats. So definitely want to be proactive with your service providers.
Got it. Makes perfect sense. And same thing that I tell my clients. Style fit is important.
Yeah, absolutely.
Yeah. So, okay, last question for you. In your opinion, what's the smartest thing a new fund manager can do when they're getting ready to start a new fund business?
I can only pick one thing, right?
Just one.
One thing. So, I mean, I think similar kind of in line with this whole theme, really, one of the smartest things I saw a new fund manager we recently started working with do, they went through the process of selecting all of their advisors, right? Their administrator, their attorney, their accountant. And they actually got them all on a phone call together and kind of kicked off their relationship. And I feel like that was a great way to start the collaboration because obviously we all work together, right? There's different things that, you and I might want to discuss, whether it's with the LPA or, a tax issue, fund formation, structure, all those things. And being able to see who the other person you're going to be dealing with, I thought that was a great idea to kick it off. And Not to say that every new fund manager needs to get all of their providers on a phone call when they get started, but I think kicking off or introducing those relationships earlier on, it just helps with making things seamless in that first year and trying to avoid some of the hiccups we see people run into.
That is really nice. I haven't heard that before.
Yeah,
I don't think a client of mine has ever done that.
It's a great idea.
It's a great idea. Well, thank you for sharing that.
Yeah, thank you.
Wonderful. Well, Colleen, thank you so much. I feel so much smarter and better armed for tax-related issues that will inevitably come up. So really appreciate you joining us today.
Thank you for having me. I'm so excited to have been on the Tokens of Wisdom.
Absolutely. All right. We'll talk soon. Thanks for listening to Tokens of Wisdom with Dave Rothschild. I hope you enjoyed this episode. Please like, follow, and subscribe to our show wherever you get your podcasts. Well, now that all that boring stuff's out of the way, it's time for the part you've all been waiting for. The legal disclaimer. In this show, I describe laws and regulations from a 10,000-foot view. And while this should be obvious to most, I need to say it nonetheless. This show is for informational purposes only, and nothing I say here constitutes legal, investment, or tax advice. If you're thinking about starting a fund or you're curious about your options, this show is a good resource. But if you're going to pull the trigger and launch a fund, please engage an attorney to assist you.